Welcome to the deep dive. We take those dense corporate reports and really try to boil them down to the essentials for you.
Yeah, cut through the noise.
Exactly. And today we are deep diving into T-Mobile US. We're looking squarely at, well, just the incredible amount of stuff they crammed into their Q3 2025 report.
It's a busy quarter.
Oh, unbelievably busy. Our source material is the 10Q and their investor Factbook. And honestly, they don't just show growth. They show a company just executing this massive strategic blitz.
Right.
So our mission today is really to unpack that sheer volume of transactions they push through in just, 90 days?
Yep, 3 months.
You've got huge acquisitions, new joint ventures, some really complex spectrum deals, and yeah, throwing massive amounts of cash back to shareholders too.
And can't forget that.
We need to figure out how all these moves are reshaping T-Mobile's future, its core business, and importantly, its risk profile.
Well, I think the key thing for you, the listener, to get right off the bat is just the pace, the sheer speed. This isn't, just steady organic growth. It's like extreme operational acceleration. They're swallowing these huge new businesses, trying to rewire their internal systems and deploying just enormous amounts of capital all at once.
That takes incredible focus.
It does. It requires this really intense level of strategic and financial management.
Yeah.
And that puts pressure on basically every single part of the company.
Okay, so let's start unpacking that. This huge wave of strategic acquisitions, where's all the new growth actually coming from?
Right.
I mean, if you blinked, you probably missed the closing of the biggest one, the U.S. Cellular acquisition. That went final August 1st, 2025.
Yeah, that deal was really the anchor for the whole quarter. The total price tag clocked in around $4.4 billion.
Okay.
But what's interesting, financing-wise, is how they split it. About $2.8 billion was, straight cash transfer. But they also took on a pretty hefty $1.7 billion in U.S. Cellular senior notes, assumed debt.
Ah, okay. So leveraging debt alongside the cash to get it done makes sense for that scale. And the strategic benefit seems obvious, right? Just immediate, massive scale, especially in places where maybe they weren't as strong before.
For sure. More competition, synergies.
But how big was that immediate customer boost? Do we know the number?
Oh, it was huge.
Yeah.
I mean, this one deal just vacuumed up, let's see, 3,287,000 postpaid phone customers.
Yeah.
Plus, hundreds of thousands of others. 390,000 postpaid other devices and 349,000 prepaid customers.
So a massive influx.
Massive. And that immediately helps their synergy goals, obviously, but maybe more critically, it boosts their rural 5G coverage. That was a real gap they needed to fill.
Okay, but T-Mobile wasn't just focused on bulking up the core wireless side, right? They also made this, pretty major strategic pivot into fiber.
That's right.
Almost like buying their way into the broadband infrastructure game, but through these 50% equity stakes in joint ventures.
Yeah, you nailed it. The U.S. Cellular deal, that strengthens the current business, right?
Right.
But these JVs, they're the signal about the future model. It's diversification into wholesale fiber access. The biggest move there was Metronet. That closed in late July. T-Mobile put in a whopping $4.6 billion.
$4.6 billion.
For a 50% equity stake. But it also meant that 713,000 fiber customers, specifically their residential retail side, just immediately shifted over to T-Mobile.
That's a huge investment, $4.6 billion just for half ownership. And then there was Lumos, too, earlier in the
Right. Lumos closed back in April. That was a bit more modest, though still pretty substantial. $932 million investment for their 50% stake.
Okay.
And that added about 97,000 fiber customers. And it's worth noting, the commitment doesn't actually stop there.
Oh.
They're expected to kick in another $500 million, $500 million into that Lumos JV between 2027 and 2028.
Right.
That's to fund future fiber builds.
So, wow. T-Mobile is really aggressively chasing two very different growth engines at the same time. You've got integrating the pure wireless scale from U.S. Cellular and setting up this, pretty capital-heavy wholesale fiber model. Isn't there a risk there? Like chasing two rabbits, spreading integration resources may be a bit too thin, especially when these fiber JVs are still only 50% owned.
Well, that is the $5.5 billion question, right? That's roughly the combined investment in those JVs.
Right.
If you connect the dots, the bigger picture here tells us T-Mobile is prioritizing having an answer for fixed broadband. They probably like the JV structure because it, maybe minimizes their direct operational headache while still giving them maximum exposure to high-speed fiber.
Yeah.
They're basically building options.
Building optionality. Okay.
Yeah.
And when you add up all these acquisitions, the total customer base is getting close to 140 million.
Nearly there, yeah. But what's really impressive, I think, is that even if you strip out every single acquired customer, their organic net adds,
Their own growth.
their own growth, yeah, it
Yeah.
still jumped 49% in Q3 this year compared to Q3 last year.
49%, even with all the M&A distraction.
Exactly. They're speeding up growth on literally every front.
Okay, think about that. They're adding customers faster through their own stores and website and just hoovering up millions more through these deals.
It's pretty rare to see that kind of dual acceleration. It really speaks volumes about their current market power, the appeal of their 5G network.
Okay, but this kind of massive expansion takes, well, massive capital. So the big question becomes, how do you actually pay for $4.4 billion in wireless deals and another $5.5 billion in fiber JVs, like at the same time?
Right.
Which brings us to the financial engineering part. This is where it gets really interesting, maybe a little complicated. Managing spectrum, juggling debt.
Exactly. And Spectrum, it's their crown jewel asset. They're managing it almost like a financial portfolio.
Straightening it around.
Pretty much. They did complete a pretty significant sale back on April 30th, 2025. Sold off a chunk of their 3.45 gigahertz licenses.
How much did they get?
$2 billion cash.
Yeah.
$2.0 billion. And that generated a nice, clean $151 million gain for them. Smart monetization.
Okay. And they've got another big one cooking, right? That involves cash and, swapping assets. This is the one that's a bit confusing.
It is complex, yeah. Let's try and break it down. That's the deal with grain management.
Okay.
So T-Mobile is selling off some, let's say, non-critical 800 megahertz spectrum. They get $2.9 billion in cash for that.
Good chunk of change.
It is. But in return, they also get cleaner ownership of Grain's 600 megahertz licenses. Now, this is spectrum they were already leasing anyway.
So they're tidying things up.
Basically, yeah.
Yeah.
It's an optimization trade. They get a pile of cash, and they consolidate ownership of their really important low-band 5G spectrum. Makes sense long-term.
That's a pretty clever strategic asset swap. But that deal doesn't come free and clear, does it? I thought I saw something about a big tax hit.
You did.
Yeah.
There is one. T-Mobile is actually anticipating about an $850 million increase in their cash income tax liability when that deal closes. Yeah. It's expected late this year, maybe early next. It just highlights, that generating cash by selling assets often triggers these near-term financial obligations you have to plan for.
And speaking of financial obligations, we have to talk about the debt that's fueling all this rapid growth.
Right. Well, total debt, if you exclude their tower obligations, it stood at a pretty substantial $86.5 billion at the end of Q3.
$86.5 billion. Wow.
And to fund all the M&A and just keep the lights on, they generated $8.3 billion in proceeds from issuing new long-term debt just in the first 9 months of 2025.
So they are definitely tapping the debt markets heavily to drive this whole aggressive growth cycle.
Absolutely. Taking full advantage.
But, despite all that spending, this quarter was also marked by a really strong, clear signal back to the market saying, hey, we haven't forgotten about investors.
Yes. The shareholder return program.
Exactly.
And that commitment is really key, right? For keeping Wall Street happy, especially with that high debt load. The 2025 stockholder return program, it's authorized for up to $14 billion through the end of this year.
$14 billion.
And as of September 30th, they'd already done $7.4 billion in stock buybacks and paid out another $3.7 billion in dividends.
So that's over $10 billion already returned.
Yep. Which means they still had $3.6 billion left in that authorization as they headed into the big Q4 holiday season.
That strong $14 billion commitment really does send a clear message to Wall Street, doesn't it? It's like saying, look, we can afford these huge acquisitions and still reward you guys heavily.
It signals confidence for sure.
Okay, let's pivot a bit now to the actual operational results, because those showed maybe a bit of a mixed picture across the revenue lines, comparing Q3 25 to Q3 24.
Yeah, a little mixed. Overall, total service revenues, they were up a healthy 9%, so good top-line growth.
Okay.
And the main engine, as usual, is the postpaid segment. That was up 12%. And that lift came from, well, both the acquired customers, US Cellular and others, and importantly, higher postpaid ARPA.
Average revenue per account.
Exactly. That shows the value they're getting from each household, basically.
Yeah.
And that metric hit $149.44. Pretty strong.
Okay, strong on postpaid. But the prepaid side, which is often, more price sensitive, that saw a bit of a pullback.
It did, yeah. Prepaid revenues actually decreased 3%. Management pointed to lower ARPU, average revenue per user.
So getting less from each prepaid customer.
Right. Even though their actual customer count was up, mostly because of that Keyna acquisition they did earlier. So the challenge there seems to be monetization, getting more revenue out of those prepaid users.
Got it. Now, in all these really fast-moving reports, T-Mobile keeps highlighting core adjusted EBITDA. That was up 7% to $25.5 billion for the 9 months. They emphasize that over standard GAAP net income. Why is that specific non-GAAP number so important for how they track performance internally?
Yeah, that's a really crucial distinction, and it reflects just how complex things are right now. T-Mobile is pretty explicit about it. They say they use core adjusted EBITDA because their regular GAAP net income number is just getting wildly distorted right now by all the financing activity.
The deals and debt are messing up the bottom line number.
Totally. I mean, think about it. When you're constantly doing multi-billion-dollar spectrum trades, integrating these massive mergers, issuing tons of debt, your interest expense and your income tax figures become so incredibly volatile
Right.
that they're almost useless for tracking the sort of day-to-day operational health of the core wireless business. So EBITDA strips out those financing and tax distractions, lets them see the underlying performance better.
That makes perfect sense, especially given the sheer volume of M&A we've been talking about. But the internal overhaul needed, that's also showing up in some negative numbers, right? I wanted to ask about that $278 million non-cash impairment expense. That seems like a huge number.
It is a huge number. And it's a massive sort of internal red flag, you could say. That $278 million, it was a non-cash write-down related to capitalized software development costs, specifically for their billing system replacement plan.
Okay, in plain English.
In plain English, they poured a bunch of money into developing a new billing system, capitalized those costs on their balance sheet, as an asset.
Right.
And now they've realized that a big chunk of that software investment is basically worthless. Either the plan failed, or it just couldn't scale or adapt to handle the complexity of the newly combined business, especially after Sprint and now U.S. Cellular.
So this is a really clear sign that those accelerated digital transformation initiatives, they talk about basically integrating this massive sprawl, are hitting some major expensive roadblocks in their core systems.
Precisely. It really shows the true cost of modernization. It's not just the cash you spend. It's also recognizing when your prior investments just aren't going to cut it anymore. They're fundamentally impaired. And that's a constant battle when you bolt on businesses as aggressively as T-Mobile has.
And those integration expenses, they're just piling up, aren't they? You mentioned the U.S. Cellular integration alone is like a multi-year project.
Absolutely. The direct costs just for U.S. Cellular, things like integration planning, restructuring, transaction fees, they totaled $73 million in Q3 alone.
Just for one quarter.
Just for Q3.
Huh.
And management is projecting that these really complex integration and restructuring activities are going to continue all the way through the end of 2027.
Wow. End of 2027.
Yeah. So this is a known multi-year drag on their immediate profitability that they just have to manage.
Okay, so the challenge of integrating these huge acquisitions, modernizing core systems, that naturally leads us to maybe the biggest external risk factor, data security. I mean, even with all this forward momentum, the cybersecurity fallout is just the story that refuses to go away for them.
It really remains an ongoing substantial liability.
Mm-hmm.
We should probably differentiate between the two big incidents people remember. The fallout from the really big August 2021 cyber attack that's now mostly settled and finalized. It involved, paying out $350 million to fund claims from the class action settlement.
Right.
And they also committed to spending $150 million on security upgrades back in 2022 and 2023.
Okay, so that one is mostly resolved financially, at least. But the legal risks didn't stop there, did they?
No, unfortunately not. They are still actively responding to ongoing regulatory inquiries, potential consumer class actions, all related to that separate January 2023 API breach.
The one that hit, 37 million accounts?
That's the one. Impacted about 37 million customer accounts. So yeah, legal risk in the cybersecurity area remains very active and pretty substantial for them. It just eats up management attention and resources that, frankly, could probably be better used on integration right now.
And all this complexity, all these moving parts are effectively being handed off to new leadership, right?
Yeah.
There's a major executive transition happening, right now, November 1st.
That's right. CEO G. Michael Sievert. He's retiring from the top job. He'll transition to a vice chairman role.
Okay.
And Srinivasan Gopalan is stepping into the CEO position on November 1st. It's a huge handoff.
A massive transition at a critical time.
Absolutely. And to make sure that transition goes smoothly, keep key talent, T-Mobile has committed pretty substantially. For example, they set Gopalan's Minimum target long-term incentive, the LTI, at $8.575 million for both 2026 and 2027.
Wow, that's a big financial commitment. It certainly signals the board's confidence in the new CEO.
It does.
But it also means Gopalan walks in the door and immediately inherits this incredibly active integration roadmap, these multi-billion-dollar JV commitments, complex spectrum deals still pending, all while trying to navigate this ongoing cybersecurity litigation. Talk about hitting the ground running.
No kidding. It's a full plate from day one.
Okay, so let's try and pull all this back together for you, the listener. Q3 2025 for T-Mobile was just defined by unbelievably aggressive acquisitions that really transformed their footprint. You had the sheer wireless scale from U.S. Cellular, plus the strategic fiber plays with the Metronet and Lumos JVs.
Right, two different fronts.
And this ambition, it was funded partly by selling off spectrum profitably, issuing a lot of debt, but also somehow still honoring this huge shareholder return commitment.
Kept the investors happy.
But internally, the picture is maybe tougher. They're staring down some massive system integration pain. You saw that with the $278 million impairment charge.
Yeah, the billing system right down.
And still dealing with mounting legal risks from those past cyber incidents.
So what here, I think, is really the sheer complexity facing the incoming CEO and, by extension, investors. They've definitely succeeded in translating massive capital spending into really rapid growth. That part's clear.
Right.
But the ultimate success, that depends entirely on how well they execute these multi-year integration plans, the system modernizations, especially when you factor in those known integration costs and these sort of recurring regulatory headaches.
Execution is everything now. So here's the final thought for you to maybe mull over. Given just the incredible pace of acquisitions in the first 9 months of 2025, you've got U.S. Cellular integration, these brand new fiber JVs. Can the company truly maintain its financial discipline and hit those synergy targets, especially through this big leadership transition? Or will the sheer weight of all these integration expenses eventually start to slow down the momentum we've seen?
That's the big question going forward. Thanks for joining us for the deep dive.
We'll catch you on the next deep dive.